Hi, this is Steve Holloway, and you're watching the Advocate Report. It's May 27th, 2014, and the S&P closed at 1,911 points. That is the highest nominal close in the S&P 500 ever. A very, very interesting thing. There's an old adage in the stock market that goes something like this: buy low and sell high. And so we look at stocks today traded at least their nominal highs. Should we be buying stocks today, or should we be selling them based on that very, very old investment adage? Well, that's a good question. What are these values relative to what history has shown us? Are they trading at higher prices relative to earnings, or are they values right now? Many people on the mainstream media would tell you that stocks are a great value right now and that you ought to be purchasing stocks, or at least holding your stock portfolio. And I would beg to differ. Go with me, if you will, to the first chart. And this is from Doug Short. He does an excellent job with his data and his charts. And he's showing us 4 different valuation metrics of the stock market going back to 1900. That's 114 years worth of history. Now, I would right up the front tell you that this is a terrible chart to try to day trade on, whether you should be in the market or out of the market this week or this month or next month. But it certainly gives you an idea as to whether we're trading at high prices, overvalued prices, if you will, or fair prices, or underpriced at low. These are great values. So if you go back and you look at the Crestmont PE ratio, and this is from Crestmont Research Company, and they're an excellent company, they would tell you that right now the market is overvalued by 97%. There are only 2 other periods of time, going back to 1900 at least, that the market has been priced at this level: 1929 and 1999. And those are the only 2 periods of time that occurred. Look to the next one, if you will, the red line. That's Shiller's PE10 ratio, and he's popularized that ratio. It's the most conservative way to look at market valuations because it's assuming earnings averaged over a 10-year period of time, and he's saying that we're currently overvalued by 62%. And if you look at his chart, or if you look at that graph relative to the red line, you'll see that there are just a few other periods of time: 1929, as we'd mentioned, 1999, and in 2007 as well. So those are the 3 periods that set a precedent. And finally, if we'll look at the Q ratio, which is another way of looking at earnings relative to market prices on a more macro basis, that comes from Tobin, who won a Nobel Prize for his work there. He tells us the market's currently 75% overvalued. If you look at Tobin's valuation method, we currently only have 3 other precedences: 1929, 1937, and 1999 to look at as periods of time. Now, based on these valuations, based on ratios, the PE ratios that we talk about, and by the way, that is the foundation of stock pricing. If you're trying to determine whether you're buying low or selling high, or where you're at in that mix, then look to PE ratios. It's an excellent way to see this. And Doug Short has done a marvelous job of helping us to interpret where we're at relative to buying low and selling high. Currently, if you look at prices, depending on any number of these valuations that we've shown you here, you're trading at market prices that, again, you only have a handful of precedences. As I mentioned, 29, 99, 2007, and today. And in every instance and we don't know what the outcome will be today, but in the other 3 periods of time, the markets fell by anywhere from 50 to 85%, devastating to a portfolio. And yet you hear people today telling you that you should either hold your stocks or buy more. And in fact, if you look at some of the weakest companies relative to balance sheets, the quality of the balance sheet, they have outperformed the S&P 500 by almost double over the last 2 years. It's called a dash for trash, because people are trying to find value in a market that there is no value. So will the market go up into the future? Perhaps it can. Why has it gone up? Another great question for another video at another time. Quantitative easing, I think monetary policy by the Fed has had a huge impact. Stock buybacks, which we'll cover in another video, have had a big impact. If you go back to the market adage to buy low and sell high, holding stocks right now, or worse yet, buying stocks right now, is a very bad choice. But it's difficult to know where we're at. Prices could continue to trend higher, but when they do turn down, it will not end well. If you need help, or you'd like to know more about this, we're Advocate Wealth. We can help.